Dividend investors, bonjour. Mike Hiru here, founder of Dividend Stocks Rock and passionate investor. Today, I'm taking a deep dive on my portfolio to show you my top 5 technology stock. If you look at my portfolio, I have 27% of all my holdings that are invested in that sector. To be honest, it's a little bit too much to my taste. I try to have my favorite sector at 20%. But here's the thing, my tech stocks are growing too fast in my portfolio for the past 10 years, and that created this in my overall portfolio. So I'm trimming once in a while, but even then, it's still a big part. So in this video, we're gonna look at my five favorite technology stock, and I'm also going to tell you what is unique about them. And the other thing is, they are quite diversified, so it's not the end of the world if I have like a lot of companies invest in the same sector because they are in a different industry. But before we start, you're gonna tell me, but Mike, I'm not really interested in tech stocks because they don't pay that much of a dividend. Okay, so here's a trick. I bought Apple in the first time in 2014. My yield on cost on this one is 4.67%. So it's like paying the same thing as a utility stock while it's a tech stocks, right? Offering a yield today that is less than 1%. I bought it again in 2017 in my pension income portfolio. And if you want to know what's in my pension income portfolio, you can download it in the link description below. I update it every month on the Dividend Guy blog, and I show you everything that is happening in this portfolio. Why? Because I cannot add more money into it, which is make it a real case study, very interesting. There's no addition of capital, it's only capital gains and dividend payment, and it just grows. It has doubled in the past 6 years. So in 2017, my yield on cost on Apple is now 2.34%. So you can see how dividend growth for a great company could compound very fast and eventually becomes a great dividend payers, even in terms of yield. So let's talk about my largest holding in my portfolio. It's still Apple. Apple represents 10% of my total assets across all my accounts. You can see that on the dividend triangle why I have decided to invest in this one. It has been a growth machine for many years. Right now we can see that since 22, revenue and earnings are a little bit more stable, so we probably won't get that generous dividend increase in 23. We're gonna get one, but it's probably not going to be double digit. You can see that the stock price has stagnated as well for the past like 12, 18 months. But before that, it had a huge ride. And this is why it's so important to look at your portfolio and trim when a position goes too high. So the last time I sold some shares of Apple, because at one point it was up to 17% of all my assets, I sold a part of it in 2020 and another part in 2021. What makes it unique is that they have kind of a 2 different business inside one. The first one is the classic business that I will call, which is obviously the iPhone business. That is half of their revenue, and it's an iconic product. They keep innovating them, but at one point, obviously, I did a video on that. It will be hard to continue to innovate and you cannot add like 25 cameras on it, and there's a limit of the pixels that you can add as well. So obviously, maybe the growth for that part will slow down, but on the other side, it is a real cash cow and it's generating like tons of cash flow every quarter. What is great about that cash flow is that then Apple takes it and reinvest it in new products and new ideas. They have created literally 2 great business inside their businesses. So the first one, wearable, home and accessories, with $41 billion in sales in 1 year alone. So you have like many businesses that are not even able to reach that huge amount, and that is just a side business for them. They did the same thing with services with $78 billion, and what is most interesting is those 2 businesses has been increased by more than 10% per year for the past 2 years. There are a lot of growth vectors coming in over there, and this is why I love Apple. They generate their cash flow from their base business model, and then they reinvest in new ideas. They don't need to be the first one, and it's still working. And quickly, one thing that I also appreciate is the geographic diversification. So when you invest in Apple, don't necessarily need to invest in international market. You have half of the business that is actually happening outside of North America. So this is also a great way to diversify your portfolio by adding a single stock in your investments. Now moving on to my second favorite tech stocks, Microsoft. That is 5% of my total assets. This one obviously grew a lot, and here's a funny fact. I bought Microsoft in 2017 when everybody, and when I mean everybody, I mean financial analysts, I mean writers on Seeking Alpha, I mean FastGraph, which I have like the best respect for those services. They're all said $75 for Microsoft, that's way too expensive. Wait until it's 55. Well, unless they create a split, it's never gonna happen, right? So buying a quality business that is thriving is more important than the price you pay. And sometimes you're gonna feel that you're paying like a crazy price, but even then, you look back and you're just like, oh my God, it's growing still. So as you can see, the dividend triangle is pretty steady in terms of revenue and earnings per share. Slight slowdown in 22. That was pretty much a classic for all tech stocks anyways. You can see that the stock price also faded, but at the same time, it had such a huge bull ride. It's normal that at one point there's some kind of like a fatigue, some profit taking, but even then, the company is still stronger than ever as of today. What makes it unique is its investment in cloud. The cloud business is now getting almost to half of the total revenue. You also have like classic personal computers, and then the other part, which is like all the productivity in businesses, so all the subscription-based model with like Office 365, Dynamics, LinkedIn, and stuff like that. So you have like three very interesting segments, but what I love about Microsoft, similar to Apple with this thinking, so one is about smartphone, the other one is about computing and the cloud, but also the fact that they're able to use their cash cow, relatively mature business with personal computing, which is definitely not increasing. You can see last quarter it was actually down, but they reinvest that in new ideas. Among their best ideas over the past few years, well, they've been investing in ChatGPT, so a lot of investment is coming into AI, but they're not in the chip processor and the semiconductors business. They want to use AI most likely like a software if you're thinking going forward. So I think that there have been a smart place here. They have taken a technology edge, may continue to last, may not, but at this time they are allocating their capital in a very smart way, and this is one thing that I really love about Microsoft. Here's another one that is a little bit of a curveball, and it's Visa. And then a lot of people will say, but Visa, Mike, is it not in the financial sector? Like, I don't get it. Well, here's the thing. Visa does not hold the debt in their balance sheet. That belongs to the bank issuing the card. So Visa is really a payment processor. That's why we're talking about technology. As you can see, it's going quite well. Unless they are in a recession, they're growing all the time. Why? Because they're making money on the transactions and not on the debt and the interest that is being paid by customers. So they don't care about default. It's not their business. They don't care about interest rate. It's not their business. They do care about the economy. So one could argue that actually Visa is 1/3 tech stock, 1/3 financial, and then 1/3 consumer discretionary, because most of their money is being made when consumers are confident, they're making a lot of money, and they're doing a lot of spending. What's make it unique is their key business driver. So we're talking about volume and cross-border volume. So what is the most important part for Visa is not only to have consumers spending money, but also traveling. Why? Because it drains a lot more fees when you pay with your card. And it's pretty like the most convenient way to pay when you're traveling in Europe. You just bring up your card and then you just pay. You have a MasterCard, you have a Visa, it's pretty much the same thing. They have the same business model. Full disclaimer, I have Visa in my portfolio, but MasterCard has been a better performer. Both have been doing great, but MasterCard has been better. I decided to pick up Visa because it's the #1 leader in this industry, but MasterCard is #2. Quite a challenger, to be honest. Both benefit from a large network, economies of scale, because it's a business based on volume. So you need those companies to be able to be across the world, so be dealing with all the merchants and their ability to treat all the transaction in a secure way, because trust is everything in finance. Well, there you go. You have an amazing business. Once again, a lot of people will tell me, but Mike, this one seems always overvalued. That's because it is growing all the time. They have several growth vectors. All the money is moving towards like digital transfer, and they already have the infrastructure in place to be able to satisfy all clients around the world. So after a curveball in terms of sector, here's another curveball, but now we're talking about a company that is not a dividend grower, and it's actually basically not paying a dividend. Constellation Software, you can see here, I've put it the US ticker, which is trading as a pink sheet, so you might not be that interested, but the reason why I put it in US dollars is because the dividend is in USD, and I wanted to show you that it's a flat line. Because if I show you the Canadian ticker, which is CSU.TO, then you'll see that the dividend seems to increase. Why? Because they're paying in US dollar, and over the past few years, well, the US dollar has been pretty strong, right? So why in the world would a dividend growth investor invest in a tech stock, already not a really good sector for dividend growth, right? And then paying a yield of like 0.20, 0.25%. So it's not even enough to pay me for a Starbucks coffee, even if I buy one share that is trading at like 1,700 US dollar or more than like 22 or 2,300 Canadian dollars, which is completely crazy. And on top of that, there's no dividend growth. So I pretty much completely destroyed CSU right now, right? But here's the thing, Constellation Software shows all the factors a dividend grower, a successful dividend grower would show without the dividend payment. So it grows their revenue, it grows their earnings, it grows their FFO per share, and it has almost no debt. We're talking about a company that has more than 40 billions in market capitalization with less than $3 billion in debt, which is amazing. The most important part, they are growing through multiple acquisitions. It's just crazy. We're talking about hundreds and hundreds of very tiny small companies being bought out by Constellation Software, integrated into one of their segments. So you can see here you have Volaris, Aris, Jonas, Vela Software, Perseus, and Topicus. And you can see all the vertical software that they've been dealing with. So all the industries. So they're pretty much everywhere in terms of industries, everywhere in terms of across the world. But the main thing here, what makes them unique, is that they focus on ultra small acquisition. We're talking like $5 to $10 billion for many of them. So they have a pipelines of like thousands of companies that they could buy, and they have developed that expertise. So what they do is that they select those businesses, they come with their reputation, so it's easier to make the deal. And those are small deals, so most venture capitalists are not that interested because it's going to be very hard to grow those businesses. But instead, they go there, they share their knowledge, their best practices, and all their infrastructure with the management in place, and they usually leave that management to just grow the business even faster and bigger. So they are able to generate double-digit growth year after year with this unique business model. Obviously, it takes a lot of time and a lot of research to understand this type of business. I get it if you're not interested in this one, but trust me, I've been told by a lot of members at DSR about this one for several years. I've been reluctant for several years, and then last year I started to say, you know what, I'm gonna put like that 10-15 hours that is required to understand what's going on with this business, and today I'm glad I did. Last but not the least, Texas Instrument. Last year I did a full video on this one. Semiconductor. So now we have a smartphone business, a software cloud, investing in artificial intelligence business. We have a payment processor. We have a conglomerate of acquisitions. So you can see that already we have like 4 types of completely different businesses in the same sector. And I'm coming with a classic, a semiconductor. So they're making chips. Most of their processors and analog chips are being used in the industrial and automotive industry. So again, we're completely elsewhere. You can see revenue is increasing, earnings per share is increasing, and the dividend is increasing. What's interesting right now, we are at the down of an investment cycle in the semiconductor business. So numbers are going to slow down and probably be flat or slightly down in 23. And then eventually we're going to get with another up investment cycle in this industry. And when it's going to happen, it's going to fire all solid cylinders, and you're going to be very happy to have this one in your portfolio as well. What makes it very unique, I think, it's their ability to distribute cash flow in a very good way. First, super shareholder friendly. So they generate double-digit free cash flow per share growth, and what they do with that, they're buying back shares and they're paying more dividend. So almost 20 years of consecutive dividend increase is going to happen this year in 23. Share count reduction between 2004 and 22 by 47%. So they're like less than half of the shares that used to happen 20 years ago, they're gone. The most important part is while they do a lot of share repurchase and they do a lot of dividends, they massively invest in research and development and sales and marketing, which is, I think, the most important part. So they're hiring like those super engineers that are also salesmen. So those people generate the force behind Texas Instruments because they are able to not only develop high quality analog chips, but they are also able to knock on the doors and sell them to their clients. So all right, so we have the top 5 companies that I love. If you want more ideas like that in the tech sector or in others, I suggest you download the Dividend Rockstar list right in the comment below. This is a list of all great companies showing great factors, so great metrics that will propel most of them as super powered dividend growers. It's the good start to start looking at those. Obviously, just a list of metrics, so then you need to do your own research. There's still risk attached to it, but then it's a really good place to start. So right there in the comment below, and please let me know which is your favorite technology stock, which one I've missed in this video. It's already like 27% of my portfolio or 26%, so I'm not going to invest more, but I would like to open that discussion. So all right, people, don't forget to give me a thumbs up, to subscribe to the channel to not miss my Thursday morning video. And until the next week, don't forget to stay invested.